This EdTech Week session is focused on enabling you to prepare for a new investment or an acquisition. And with apologies for some, to be clear, for alignment's sake and also time's sake, because we are keeping to 1 hour, when we're talking about acquisition here, we're going to be talking about it in the context of you potentially seeking and acquiring growth partner. In other words, a private equity deal, or perhaps the sale of your business to a group for growth sake purposes, i.e. where you're going to keep skin in the game. This webinar is being recorded and we will circulate it and the slides to everyone at the end. If we've got time, we will answer any questions you have, so please do use the Q&A function. Could I have the first slide, please, Jess? So by way of background, Hannah and I are both partners in the corporate department at Fox Williams. For those of you who don't know us, we are a full-service city law firm, and we really focus on building lasting relationships with our clients and really try to provide a trusted business advisor service. Now, I head up the digital media group at the firm, and that does include our EdTech practice, and I have a particular focus on entrepreneurial and owner-managed businesses. And really, I work both for those businesses, but also the acquirers of those businesses. Now, I come to EdTech from the content-focused background, and really the use of tech to deliver knowledge and enable learning, often referred to as the front end. But I'm going to hand over to Hannah now, and she will explain her particular focus and give a bit of an overview of what we wanted to talk to you today about. Over to you, Hannah.
Thanks, Mary. So in contrast to Mary, I come to EdTech from the tech side. I tend to work with technology businesses, investors and entrepreneurs, and I've advised on the acquisition of and also the investment in a number of EdTech businesses. Mary's given a bit of a background about Fox Williams, but I think at Fox Williams we pride ourselves on being technology specialists that really understand technology disruptors and companies leveraging new technology. And like my own personal interest, the firm's interest in the EdTech industry comes more from the tech angle than the education angle, but they are very much complementary. So why do we want to talk to you today? Well, the UK has been the centre of the EdTech revolution for a number of years now, and a real driving force behind the development of an innovative tech-enabled solutions, which are really kind of intended to promote education. For all the disruption that the COVID pandemic brought, it has generated a systematic shift in the education landscape, and it's really opened the door to startups across the globe to impact the future of learning at every age. The focus on and the need for EdTech has been heightened and accelerated by the pandemic. Online learning became the new normal for customers, and education institutions underwent a radical step change in technological adoption. Unbelievable pressure has been put on the education sector over the last couple of years to flex and accommodate digital collaboration and the distance working, learning and living that we've all experienced. The upshot of this attention is that investors across the board have been alerted to the potential of the sector. The challenges that were posed by the coronavirus pandemic have exposed the potential for systematic disruption through technology in a space where technological penetration is still shockingly limited. The ensuing dynamism in the sector off the back of the pandemic has made it easier for EdTech companies to access capital, with 2021 seeing a boom in EdTech investments. Data from Bright Eye Ventures and Dealroom suggests that European EdTech VC funding tripled to $2.5 billion in 2021, which was an increase of 218% on 2020 levels. You will, however, have heard the recent murmurings of an economic downturn. So, what does this mean if you're looking for investments? Well, valuation multiples are likely to fall, and deals might take a bit longer to close. However, VC and private equity funds do have significant dry powder on both sides of the Atlantic, which I think we're hopeful will limit the fallout and really provide paths to liquidity. I think in short, there will still be opportunities to scale up, but it may be harder to agree terms. But notwithstanding this, we expect a lot more money to be kind of poured into the sector in the coming years. On the M&A side, the drivers behind the transaction we have seen have primarily been around strategic consolidation and also geographical expansion through acquisition. For companies with steadier growth, there's also been considerable interest on the private equity side. PE funds are looking to create digital education leaders that can scale products across large kind of business and government customer bases in multiple geographies. So as Mary said, the purpose of today's talk is to talk about what you should be thinking about if you're looking to sell, acquire, invest or procure investments. This talk will broadly be split into 3 parts. I'm going to start by discussing the realities of taking investments, and Mary will then talk about kind of selling a stake in your business and what you can do to prepare for this. The next slide, please, Jess. So let's start by talking about investments in EdTech businesses. When you onboard an investor, that institution or individual becomes part of your cap table, and it's for the long run. It's well known that divorcing your husband or wife is much easier than divorcing your investor, so you need to be very careful about who you're getting into bed with. Next slide, please, Jess. Every company goes through different stages with different challenges and different needs. And if you speak to most founders, they'll tell you that raising capital remains a constant challenge. As you hopefully grow from round to round, you'll meet different players with different mindsets, but you also will have different requirements. The different rounds of funding operate in essentially the same basic manner. Investors offer cash in return for an equity stake or shares in the business. But as you move through the funding rounds, the investors will make slightly different demands on the company. Your seed round is often considered to be your first third-party funding round. Before that, you might have bootstrapped the company yourself or raised funds from kind of friends and family. The seed round is likely to be funded by angel investors or perhaps smaller venture capital funds. Now, angel investors can come from any backgrounds, but often they're former entrepreneurs or venture capitalists themselves. They're motivated by the potential of big returns, but often more so the ability to give back to the entrepreneurial community and to provide mentorship to new business owners. Having a great angel investor can be a real game changer because their industry access and knowledge could be that extra enhancement that your team needs to reach the next step. We're also seeing an increase in the use of equity crowdfunding. Now, an advantage of running an equity crowdfunding campaign is that you not only raise capital, but you're also kind of marketing your product to potential users. We also sometimes see crowdfunding campaigns being run alongside more traditional investment rounds in a kind of split round structure. Now, crowdfunding can be a great way to test the market and to build momentum, but it won't be right for every company. What I would say is, from a practical perspective, if you do go down the crowdfunding route, make sure that the shares are being held by a single nominee so you don't end up with a really messy cap table, which could lead to problems down the road. Now, venture capital firms are similar to angel investors in many ways, but they tend to be more structured. So instead of dealing with one person, you'll now be dealing with a firm who specialise in making startup investments. Venture firms often rely on outside investors for their capital, which means that they operate in an extremely competitive environment. This makes them much more disciplined, but also demanding, and there's normally an increased focus on the return that they're going to get. Typically, venture funds will commit more capital than you're likely to raise from angel investors, but as I said, they will also demand more control, and they tend to focus more on the business itself rather than necessarily on the entrepreneur as an individual. It's Series A investors are looking for companies that not only have a great idea, but also have a strategy for creating long-term profit. By the time we get to Series B, many investors will be looking for companies who are able to generate consistent revenue and that can scale to meet growing demand. Series C and beyond, this is where private equity can come into play. Now, the focus is on companies with strong financial performance who are looking to expand into new markets or develop new products. You might be looking to buy other businesses or perhaps even prepare for an IPO. Typically, by this stage, a company has already proven itself to have a successful business model, and these new investors come to the table expecting to invest significant sums of money into companies that are already thriving. As I said, many of these companies will utilise this private equity funding to help boost their valuation in anticipation of either a sale or an IPO. Now, most entrepreneurs have a dream of being a unicorn, perhaps like Multiverse, the apprenticeship startup that was founded by Ewan Blair, or becoming a publicly listed company. In becoming public, a company unlocks a vast potential of funding, And if you're proposing to grow by acquisition, then the transparent valuation of publicly listed shares and a liquid market means that shares can much more easily be offered to sellers as part of the purchase price when you're doing acquisitions. However, in becoming public, you would need to expect to have a kind of significant layer of complexity to your business. You'll be required to invest in serious kind of corporate governance requirements to comply with securities laws. There will be additional reporting requirements, and investor relations become a much larger operation. There are, of course, other sources of funding that don't require you to give up equity. And whilst this can help you to retain control, it can also be more costly. Unfortunately, this is outside the scope of today's session, but there are other options out there. More often than not, the only way for an EdTech company to grow is to raise more capital. And whilst you will inevitably lose some control over the business, there are many founders and entrepreneurs who achieve a highly successful partnership with their investors, which really enable their businesses to fly. The key to the successful partnership is really choosing the right investor, which we'll come on to next. Next slide, please, Jess. So choosing the right investor is one of the most important decisions that a founder will make. In good times, the choice can make or break a startup. When times are bad, it's even more likely that the wrong investment partner could be the catalyst that starts a downward spiral. As tempting as it might be to say yes as soon as someone offers to write you a check, you should stop and think hard about the investor and the offer on the table. Now, an investor isn't going to invest their money without doing significant due diligence on the company, and you shouldn't accept their money without doing some due diligence of your own. Yes, there are VCs out there who will bring substantial investment, but do they have the right mindset and philosophy to help the business grow in a way that kind of matches your vision? Finding the right investor, as I said, is about more than just wooing the person with the deepest pockets. It's about finding someone who believes in your vision, who understands the challenges ahead of you, but also has the business acumen to help you succeed. In making this decision, it's important to have a think about what it is that you actually need. Beyond the money, what are the gaps that are slowing your success? Do you need help with your strategy? Or perhaps it's recruiting key employees? Or perhaps you need introductions to new customers, or you want to break into different parts of the market. There's significant value in finding investors who really understand the EdTech and education sectors. That's not to say you need to look for investors who exclusively focus on EdTech. There are also a lot of generalist funds out there who have invested in EdTech businesses, but sector understanding is key to have that kind of good investor relationship. We tend to find that most EdTech specialists focus on the kind of earlier stage deals, your kind of pre-seed to Series A, whilst generalists with an increasing interest in EdTech tend to be focused on the slightly later stage investments, so kind of Series B and beyond. According to PitchBook, the most active early stage investors in EdTech in Europe last year were Bright Eye, which is an EdTech specialist VC fund who's based in the UK, but also SoftBank, a more generalist fund who just happened to have an interest in EdTech. Now, when it comes to relationships, it's also important to make sure that you get on a personal level with any directors who will be appointed to the board by your investors. We will come on to discuss kind of board control a little later, but whilst the executive management team will run the day-to-day business of the company, you want to make sure that your investor directors really bring value to the board and add something to the table rather than kind of acting as a blocker or hindering your progress. And I think what's really, really important here is trust, so building that relationship and building that trust. As many of you will be aware, finding new investors at every round is expensive and it's time consuming. As we'll come on to discuss, it also dilutes your ownership, and a really busy cap table can make your company less attractive to other investors in the future. It can therefore be beneficial to try and find investors who are already in the habit of participating in future funding rounds, or who have good relationships with other investors who might decide to invest alongside them to cut down on some of these issues. Finally, it's important to have an alignment on the exit strategy between the founders and your investors, so that expectations are managed on both sides. Venture capitalists need you to make a big exit to make their business model work. and you need to have a plan to make that happen. If you've been through multiple funding rounds, you may find yourself with different investors who've got different views on when that exit should happen and what that should look like. Now, whilst an exit might feel like it's a long way off, do make sure you have those conversations before getting into bed with an investor, and make sure those conversations continue as you go through that investment journey together. The next slide, please, Jess. So if you receive a term sheet from one investor, what are some of the key things you need to think about? I'm going to attempt to explain the possible implications on value, control, and also founder shareholdings in as simple a way as possible. But do be warned, there is a lot of jargon and you will need to get your head around this before embarking on an investment process. So I think one of the key questions to ask yourself is how much equity you are willing to relinquish. A good starting point is only to take as much money as you think you really need. But figuring out how much that is, of course, is really the hardest part. If you raise too much, you could give away an unduly large proportion of your company. But if you raise too little, you could risk running out of cash before you've achieved the milestones that you need to achieve before you can then go back to investors again. You're going to get conflicting advice on this, with some people telling you to raise as much money as you can. The right answer will likely hinge on factors like the current economic conditions and also the amount of interest that you have generated within the kind of investment community. In the current climate, there's a general feeling that you should have at least 24 months of runway. Looking at it from a kind of dilution perspective, the answer is clear. Take as little outside capital as you can get away with. This is especially true in the early days. The money you raise early on is going to be the most expensive money you ever take. Your initial backers are getting equity at a time when your company has the least value. So each pound invested provides a proportionately larger stake in the business. The next thing to consider is what class of shares the investors will get. The longer that you can keep one class of ordinary shares, the better. But investors may well ask for shares with preferential rights. Typically, the preferred shares will rank ahead of the ordinary shares for income, i.e. if a dividend is paid, but also for capital, the return you get when you sell the business or the business gets wound up. In general terms, the aim of the liquidation preference is to allow investors to recover the amount they invested, or sometimes even a multiple of that amount, with priority over the rest of the shareholders. Now, there are different types of liquidation preference, which I'm not going to go into today. But the one thing I would say is that liquidation preferences can get more and more complicated as the company goes through additional funding rounds, as new investors in those rounds tend to come in at the top of the waterfall, so they have priority in the distribution over your previous investors and in turn over you as founders. From your position as a founder with ordinary shares, you will normally fall at the bottom of the pecking order. So you may find yourself in a situation, if you come to sell the company for less than a certain value, where actually you find yourself walking away with nothing. You might also heard of participating preference shares. Now these allow investors not only to reclaim their original investments back by the liquidation preference, as we've just discussed, but they can also then take a share of any remaining proceeds in proportion to the number of shares that they hold. Now, some investors might ask for preferential dividends, and that might be in the form of a fixed dividend, which tends to be a kind of percentage that's linked to the subscription price or amount that they have invested. Alternatively, or perhaps even in addition, they may ask for a right to receive a defined share of the company's profits, known as a participating dividend. Now, often a startup won't have distributable profits available to pay dividends. So what you tend to find is that if investors do have these rights, those preferential dividends will roll up and end up being payable on an exit, which in kind of practical terms pushes the founders further down the pecking order in terms of realizing a return. The next thing to mention is anti-dilution. So whilst anti-dilution might sound like a really good thing, it can actually be one of the most aggressive causes of widespread dilution. Essentially, anti-dilution works to protect investors from future rounds of funding where the price per share is lower than the price that they paid for their investment, also known as a down round. It acts as a cap, preventing the investor shares from being diluted past a certain point. Now, the concept of anti-dilution is that as your company's valuation has fallen, in order to preserve the investor's value in their ownership percentage, that ownership percentage must increase. And usually that involves giving the investor extra shares at no cost to them. The calculation of the extra shares is key, as this has the potential to be extremely dilutive to the founders. Again, it's outside the scope of today's session. Another thing that can have a really big impact on dilution, and in turn the value of your shareholding, is the option pool. Now, option pools are really important for staff incentivization. However, you should pay careful attention to the wording of the term sheet, which will often include either the creation of a new option scheme or the increase in the size of an existing options scheme as part of the investment round. Now, typically, option pools range from kind of 10 to 20% of the company's share capital, with the percentage being determined either on a pre or a post-money basis. Now, if a term sheet states that the business's pre-money valuation includes an option pool valued off its post-money fully diluted share capital, then the creation of that option pool will be funded entirely by the shareholders before the investment occurs. So your existing shareholders, yourself included, will be diluted first by the creation of the option pool, and then you'll be further diluted by the new investment that's coming in. In a more egalitarian scenario, the option pool is created post-financing, which results in the new investors and also your existing shareholders sharing in that dilution. Now, the final thing to note is that it is market practice on investments for the company to pay the investors' legal fees, often up to a kind of pre-agreed cap. So it's just a note to say this will need to be factored into the cost of raising funds. So ordinarily, these fees will just be deducted from the amounts invested. So on completion of the investment, you may find that you end up with less money in your bank account than you were expecting. Some investors will also charge a management fee, which is normally an annual percentage of around 1.5% to 2.5% of the funds that they've invested. These fees allow the fund managers of those larger funds to meet their own operating costs. The next slide, please, Jess. So, as well as provisions that may have an impact on the value of your shareholding, the investment documents will also normally include terms that affect your control of the company. Investors will typically ask for the right to obtain certain financial information, as well as the right to inspect the company's corporate records. The term sheet will typically specify that annual, quarterly, or even monthly financial statements are to be provided to the investors, as well as an annual budget or business plan. These rights might just be restricted to kind of major investors, and typically we find they aren't a source of controversy or even much negotiation. But do make sure that you're not creating extra work for yourself and try to limit the information to information that you already prepare on a regular basis. Now, one of the key control mechanisms for any company is the process for the election of the board of directors. And the makeup of the board is important to the investors as well as to the founders. Now, VCs, especially if they are the lead investor in a financing round, will often want the right to appoint a director to the board to be able to monitor their investment and have a meaningful say in the running of the business. As a founder, you will likely want to maintain control of your company for as long as possible, and to ensure that you retain a right to hold a board seat for as long as you hold shares. Really kind of careful thought needs to be given about the proper balance among investors, the company, the founder or founders, and also independent and non-executive representation on the board. The makeup of the board and the decision-making processes can be one of the most highly negotiated parts of an investment term sheet, so be prepared to have that conversation. In some cases, rather than taking a seat on the board, investors might look for observer rights so that they have the right to send non-directors to sit in and observe board meetings and to receive copies of board papers. Those observers don't, however, have a voting right. Whilst you might see this as a good compromise, rather than giving an investor a kind of full-blown board seat, do be wary of observers, because sometimes you find that they don't add any value. Often it's not about who votes at a board meeting, but it's more important the discussion that actually occurs. So you can find that an observer can kind of sway the balance of the board if they're party to that discussion. And whilst board representation really is to be expected, especially as you kind of get later on in terms of investment rounds, it can prove unwieldy if you've gone through several rounds of investment with new institutions coming on at each round and asking for a new board seat. There will inevitably come a point where the board composition may need to be consolidated. And again, it's about having that open dialogue with your investors to work out what is best for the company going forward. Another key point for investors is veto rights or kind of consent matters. So venture capital investors will normally require that certain actions can't be taken by the company without their consent. The purpose of these rights is really to protect the investors from the company taking actions which might adversely affect the value of their investment. Now, sometimes those consent rights are split between the consent of an investor majority, i.e. decisions which are kind of taken at shareholder level, and the consent of the investor directors in relation to matters that are taken at board level. Typically, matters that require investor consent would relate to really kind of major changes in the company, such as changes to the company's share capital, deciding to sell the company, or perhaps its major assets, buying another company, winding up or liquidating the company, or perhaps even incurring debts above a certain amount. Whereas more operational matters that might need more urgent consideration by the board would be left for the investor directors to consent to. And this might include things like appointing key members of the management team or senior employees, or perhaps taking on new office space. One of the most sensitive of these veto rights is the one granting the investors effectively a blocking right on the sale of a company. There are ways that this can be mitigated, and as a founder, you might try to argue that this kind of veto right shouldn't apply in situations where investors receive a minimum return on their investment. What I would say is that whilst there will inevitably be a long list of kind of consent matters or veto rights, you can take some comfort from the fact that abuse of veto rights by investors is very rare. Word spreads very quickly in the venture world. VCs know that if they're arbitrary and blocking kind of sensible deals, it will adversely affect their reputation with future entrepreneurs. And finally, just to finish the section on control, when you've got more sophisticated investors on board, you can generally expect there to be more demands, more stringent processes around the corporate governance of the company and how business is run. So do be prepared for that. Next slide, please, Jess. So the final thing to consider when looking at a term sheet is whether there are any provisions that will have a more personal effect on you as a founder. So we touched on founder dilution when we spoke about understanding the value implications, so I'm not going to go over that again. You might find that there are restrictions in the term sheet on you doing things like selling your shares. This might be an absolute prohibition on the sale of your shares for a certain time period, or the investment documents might provide that investor consent is required. Another important and often heavily negotiated piece is around the good leaver, bad leaver provisions. So it's often the case that employees who hold shares will be forced to offer up some or all of their shares when their employment comes to an end. As a founder, ideally, you'd argue that any such provisions wouldn't apply to you, but it's increasingly common for them to apply to some degree. Founders and senior management are usually central to the decision of the investors to put money into a company. And having decided to back a management team that they have confidence in, investors are usually keen to ensure that that management team stays in place to deliver the business plan. If the good leaver, bad leaver provisions do apply to you as a founder, then ideally some or all of your shares will vest over a certain period of time, so that they're no longer subject to the good leaver, bad leaver provisions, and therefore there'll be less impact should you leave in the future. From an investor's perspective, this acts as an incentive for the founders not to leave employment with the company in the short term. but you would appreciate that it is one of the most emotionally charged issues for founders, and one of the points that can often be negotiated right up to the wire. It may be that your investors expect you to remain active in the business for an agreed period, so for example, for 4 years, and that a quarter of your shares will then vest at the end of each year, so that if you leave after 4 years, you'll be allowed to keep all of your shares. But an additional annoyance for founders is often that the vesting schedule will reset each time that there's a new funding round, meaning as founders, you're required to lock up your shares again and again. A couple of final points on implications for founders. The investment agreement will normally include warranties given by the company. In addition, these warranties are usually also given by the founders in their personal capacity. So warranties are statements of fact about the company, which, if untrue, may provide the investor with a basis for a claim for financial compensation if the value of their investment is affected. The company's liability will typically be limited to the amount invested, 1 to 2 times your annual salary. And finally, the investment agreement will also include restricted covenants, which will constrict what you can do if you leave the company, which again, another source of negotiation. I will now hand over to Mary, who's going to talk about selling your business.
Great. Thanks, Hannah. So while Hannah has talked about the key aspects of taking investment into your company, I wanted to talk through the key considerations you should have in mind if you're looking to be acquired by or form part of a larger group, and that's possibly with the promise of equity or having a significant role higher up in the group structure. Now, as Hannah mentioned at the beginning, there is a huge amount of investment potential in the edtech space at the moment, and we're increasingly seeing aggregators dominate the market. And more often than not, those aggregators are PE backed, but we are also seeing a number of the bigger trade players following a similar path. Being acquired by one of those players can certainly be very exciting, and it can catapult your product to the next level. And in addition, there's real potential for you and the key members of your team to accelerate your careers and perhaps start taking responsibility for parts of the larger group, and who knows, go all the way up to be CEO. But the one message I do want to get across is to really, really think ahead. Jess, could I have the next slide? So there is no denying that the opportunities a PE-backed business or listed company can give an ambitious founder or an executive can be life-changing. PE-backed groups are often extremely dynamic, fast-paced, and there's a real opportunity to have skin in the game. And large corporates and listed companies can provide really exciting career paths up to the executive board level. The resources that come from being absorbed into the large group can be game-changing even for your business, and that may help you elevate your deal value significantly over time as your business gets to realize its full potential with all those capital and resources behind it. However, there's inevitably going to be change for you and your team, and that's good and bad. While there can certainly be career opportunities for your team, human resources are an easy target when it comes to economies of scale. If culture is important to you, will the buyer be able to provide the right home for you? And if you are a founder or owner, are you prepared to become just another just another employee again? Remember that private equity only has one agenda, and that is to return its investment to investors. To do this, they need to make their businesses more valuable on exit than when they invested. To make this happen, it has to grow, become more profitable, de-risk, maybe diversify, all those really great things in building a successful business. But do you want to grow in the same direction and in the same ways? Now, there's no one answer to all of this, and it really comes down to personal preference. I have advised founders on sales to big corporates where they've been promised really exciting executive roles, only to find that big environment mundane and bureaucratic. But I've also advised owner-managed businesses who've sold outright, and 2 months down the line, they're really missing the drive and stimulation of the business. So my advice to you is really, when you're weighing up offers you've got, to determine and really think through what is it you want at 18 months, 3 years, 5 years, 10 years. And this will become particularly important if you do think that at some point you want to do something else, whether that's start from scratch again or maybe become a net. You need to factor that in, particularly when you're discussing the restrictive covenants. Those are the non-competes, non-solicitation clauses, that any investment house or trade buyer will want you to give. And my advice is to find people who've done this before, talk to them and really explore all your opportunities. Yes, next slide, please. But at the same time as working out what you want for the future, you need to be making sure that your house is in order and that all your ducks are in the row. Next slide. So the truth is, it is never too early to get good advisors on board. And one of the main problems all advisors have is that clients never really know the true worth of good early advice until it is tested. And if they haven't got it, it will be too late. In many ways, you never want to have to rely on particularly legal advice, because if you do, something has gone wrong in the commercial relationship. Now, I'm acutely aware that small and SME businesses can see legal and financial advice as an unnecessary or certainly perhaps unaffordable cost. However, I do see more often than not when it comes to an investment or an M&A transaction, many of the major issues that come to light could have been avoided had lawyers or accountants been involved at the start, or at least at an early enough stage to resolve issues before they can negatively impact on the investment or sale. So as soon as a transaction is a speck on the horizon, you should be lining up your advisors or double checking that the advisors you have on board are the most appropriate. Now, for early to mid-stage companies, I actually recommend that the first port of call is your accountants. The first thing a buyer or investor will want to see is your accounts. And as the deal progresses, it will be the financial due diligence that kicks off first. Having good accountants to hand can really help ease the load on you, and if you've got one, your finance officer's workload. Now, in the current climate, I would say we're seeing about 60 to 65% of trade and PE deals arise from a direct approach from the buyer or investor, and the other 35 to 40% are arising out of an active decision to go to market. If you are in the latter camp, engaging with a corporate finance advisor can have real benefits. Now, first of all, by picking the right corporate finance advisor, you gain access to their sector-specific contacts. And this is where it is important to ensure you find the right fit. There are plenty of incredibly good generic corporate finance advisors out there. And indeed, I would say now, those that are tech corporate finances are themselves incredibly generic. And while there is an advantage of the breadth in their contacts, I often see that the best mid-sized, slightly larger transactions are brokered by boutique and sector-specific advisors. And there are plenty of EdTech specific advisors out there. But a good corporate finance advisor is not just about their network. If you have a long-term goal for a sale or that step up, the right advisor can really help you get your house in order and help you get the best price for your business. Now, I'm currently working on a sale transaction where the corporate finance advisor has been engaged by the company for 4 years and has worked with that company on strategy and housekeeping and really producing that great sales pitch. So the purchase price that they're now commanding is considerably higher than I would have expected had they come cold to market this year. The other role a corporate financier can play is in fronting the deal, i.e. they manage the commercial negotiations. But having said that, you need to consider the appropriateness of this in the context of your deal. If management and owners are seen as key to the ongoing success of the business and are being incorporated into the group, buyers may be frustrated by any perceived corporate finance barrier. If, however, the transaction is a complete exit, having that middle person can reduce the stresses of a deal. But I should mention that the skill set that a corporate financier can bring can also be brought or certainly enhanced by having a good non-executive director or chairman on the board. Now, I'm a big fan of non-execs on private company boards. That's outside the scope of this talk. But in terms of transaction management, having somebody on the board who has seen it all before and who knows the industry can not only help make the transaction happen, but they can also help steady the ship while the transaction takes place. But in order to get a deal done, the one thing you really can't do without is legal advice. Now, obviously, I would say that, apologies, but the truth of the matter is good transactional lawyers can really add value to your deal. And I do emphasize good transactional lawyers. While most people think of corporate M&A lawyers as potentially just papering the deal that's already been done, the good transaction lawyer will make sure that in getting that deal done, they take the strain of the deal off management, who have to continue running the business, and they will focus management's attention on the key commercial issues rather than just the legal niceties. And they should also be able to help all parties identify issues ahead of time. Next slide, please. Ultimately, good lawyers should help you understand and control the process whilst minimizing business disruption. Now, this slide provides a very high-level view of the legal steps involved in a disposal or investment. And while different documents are required, the concepts and processes are largely the same. So if you are going to market, the first document you'll need to produce is your sales document. Normally an information memorandum if you're selling, or that famous pitch deck if you're looking for an investment. If the sales document attracts interest, we do strongly recommend that you request a potential investor or buyer enters into a confidentiality or non-disclosure agreement before sharing any further information about your business. And at this stage, the information we're talking about is enough to enable the buyer or investor to put forward an offer. And that will be documented in a term sheet or heads of terms. Now, my one advice here, and I'm slightly doing myself out of a job, is don't let the lawyers negotiate these documents too heavily up front. Now, the term sheet for an investment will have a lot of detail in it because it deals with the management of the company going forward. But all these documents will have to be renegotiated when we come to the key transaction documents. What you want to be focusing on is the key elements and deal breakers. If there is anything that you absolutely won't do the deal without, or you are expecting, even if you think it goes unsaid and is obvious, do make sure you flag it now. Once those heads of terms or term sheets are signed, you move to the due diligence. Now I'm going to cover that separately because it really is, for the business certainly, the biggest challenge in any transaction. Once the DD is underway, the lawyers start drafting the key documents. And as Hannah's already alluded to, one of the big legal risk points here is the warranties that in a sale, the shareholders will need to give, and on an investment, the company and founders will be required to give. Now, Hannah's explained these are statements of fact, and if they're incorrect, the buyer can seek to recover any losses suffered. They will run to 15, 20, 30 pages of statements. And the only way that the people giving the warranties can protect themselves is by disclosing anything which contradicts or otherwise qualifies those warranties. Now, this is called the disclosure process, and it will invariably involve a very long, often full-day meeting with your lawyers to go through each warranty line by line and stating anything that potentially contradicts that statement. And from that exercise, the lawyers will draft a disclosure letter. And that really is the key shield by which sellers and founders in the company get most protection. Once the main documents have been well advanced, there will be a whole plethora of ancillary documents, and those are board approvals, employment contracts, banking arrangements, and they will vary from deal to deal, but don't underestimate just how much needs to be papered. And once all the documents are ready, they will be signed. Even with DocuSigns and electronic signatures, that itself can take several hours. And then hopefully the deal will complete, or just in the case of a house sale, there might be a split between signing and completion. And that will depend on the deal and the commercial circumstances. Wherever possible, we do advise all parties to seek a simultaneous signing and completion. And that's because there is certainty in the deal, and there's immediate transfer of risk. But in certain circumstances, that's just not possible. And that's typically where there's government or shareholder approvals or other third-party consents. And whether any consents are needed will be unearthed as part of the due diligence process. Jess, next slide. So preparing for due diligence. As mentioned, DD is probably the biggest aspect of the transaction for the owners and management. And this is where the buyer or investor really explores every aspect of the business to kick the tires on the price they're prepared to pay, as well as indeed whether they want to go ahead with the deal. Now, while the extent of due diligence will depend on the size and nature of the transaction, but also the level of perceived risk that the buyer or investor has, it invariably takes a lot more work than perhaps most first-timers anticipate. And to make the process as less painful as possible, companies can prepare well ahead of time by ticking off many of the areas that are on the slide. And I'm not going to go through them all, but key tips are making sure you've got a detailed information memorandum summarizing the company's business, historic sales, headcount, key suppliers, etc. Make sure your financial information is up to date and to hand, And we're talking about annual accounts and recent management accounts, but also think about all your other key documents. Do you know where your employment contracts are, your shareholders agreement, your IP licenses? And as due diligence gets underway, one of the key points I do urge sides to agree is the method of document sharing. Now, from the buyer's point of view, having a secure and well-structured data room in which the documents are uploaded can really streamline and speed up the due diligence process, because you're not having to search around to work out where things are. From a seller's, shareholders, company's point of view, being able to clearly track what information has been shared and how and who has accessed it will be very important in understanding what the relevant documents are that need to be disclosed to the extent that they qualify under those warranties we talked about. And I really would caution against using generic free document sharing portals, Google Drive, Dropbox. There is still limited ability in those platforms to create automatic indexing or to run reports on when documents have been uploaded and who's accessed them. Many lawyers, including us, can provide a data room service in-house. And for larger deals, there is a whole range of organizations, Intralinks and Merrills, who can manage one for you. So do look around to find the best method. Next slide, please. So as well as helping the founders and shareholders and company to identify and resolve due diligence issues, early advice can also help identify those items that may need to actually feed through into the deal and documents itself. I have to say, it's rather alarming just how many deals I've worked on where it's discovered quite late down the line that there's another shareholder that people didn't realize about. And that is surprisingly common, where perhaps there has been a buyback from an early founder or partner who left before the company really got going. So do get lawyers to check the structure of your company, your share registers and any share transfers early on in the process. The other issue around shareholders is that if you've got a large shareholder base, you need to work out how best to run the process. So if you've got lots of minorities, are they on board? And if they're not, can you drag them? You may need to think about updating articles of association. Should you arrange for them to sign powers of attorney early on so that you're completely free to finalize and close the deal without having to go back to them? And are there any particularly difficult shareholders that need to be carefully managed? And another important aspect for sellers to consider is, how is the transaction going to be managed internally? Are management suitably incentivized? If they're not shareholders, they may be asked to give an awful lot of time over towards deal management without any reward. So you do want to consider whether you want to build in completion bonuses. And if so, those will need to be structured very carefully with the investor or buyer's agreement, because there are tax consequences and it will be a cost on the company. If you are planning for an exit in a few years down the line, do consider about building in exit-only options now to assure that there is proper alignment between management and owners. And then in other terms of things that it's useful to identify as early as possible, certainly if there are any ongoing or potential disputes, and that's with customers, suppliers, employees. And another thing that lawyers can help you with is identifying any contractual insufficiencies. We do find that quite a lot of tech companies and entrepreneurial companies don't necessarily have written contracts in place for all arrangements. And if they do, they might not be properly executed. This isn't as big a problem as lawyers might want you to think sometimes, but the best thing to do to save time is to summarize those agreements in writing so that they can be uploaded to the data room when needed. Well, one of the key advantages to identifying issues early on is to enable you to resolve them. Fine, but the best advice I can give sellers is that if you do identify any issues, you should be disclosing them to the buyer, to the investor, as early and as comprehensively as possible. There is actually nothing that will spook an investor or a buyer more than discovering an issue late in the day. And that really gives them leverage for a last-minute price chip or insist on more demanding terms. It can also make them far more wary and difficult on items that really don't have any significance, because they've rather lost confidence in your judgment and your lawyer's judgment. A buyer should certainly never be made aware of something for the first time upon receipt of the lawyer's drafted disclosure letter. If there's an issue, talk to your lawyers about how it can be communicated along the commercial principle to principles route. don't rely on the lawyers to do it. What you want to be building, and Hannah alluded to this about choosing the right investor, is that trust and that relationship with your investor and your buyer. Poor management of the disclosure process can really spook a buyer or investor, so do watch out for it. Now, I'm going to stop there, and in summary, get good advisors, engage early on in the process, make sure you understand that process and the resources required, be prepared for due diligence and use it to get your house in order so that you can deal with issues ahead of time, and make sure you disclose any issues early on in a deal so that they can be appropriately managed. Yes, I think we can go to the next slide, and actually I'm going to hand back to Hannah to see if we've got any questions we want to answer now, and do feel free to add some more in the Q&A box.
Thank you, Mary. We have had a couple of questions, and so a question that has been asked is, do we need to do anything to protect ourselves before we send out our pitch decks to investors or advisors who are external to the business?
So yes, in short, and actually when I talked about the confidentiality and non-disclosure agreement, it slightly depends on what is in your pitch deck or your information memorandum if you're selling. What normally happens is that you create a teaser, and that teaser says, what sector the company's in, what they're looking for, and you send that teaser out on a kind of anonymized basis, ideally through a corporate finance or broker, to interested parties, and say, if you're interested, sign up to a confidentiality agreement or non-disclosure agreement, so that by the time you then identify that you are yourself potentially looking to be sold or looking for investment and any other information as to the numbers involved, you've got that contractual protection.
I could just add on that, external advisors are typically subject to confidentiality obligations by their kind of professional bodies that govern them. So, lawyers, for example, are beholden to confidentiality obligations. So there's no need to ask your lawyers to sign NDAs. A question then on the investment side, is whether it's better to have a sole investor or to be looking to have multiple investors, which is a question I will take. I think people often worry about being beholden to one master investor, but and as we discussed, having multiple investors can bring a kind of diversity of thought and also opportunities for you. I think what I would say is it's important to make sure that you have a lead investor on a round if you've got multiple investors investing in the same round, who the other investors then kind of follow, so that you don't find yourself negotiating different terms with each investor. It can also be really helpful if investors have worked together before, and you'll often find that there are, especially in the venture capital world, but also in the angel community, investors who will invest in similar types of companies and who've worked together before, and they then just know how each other operate and what the important points and terms are for each other. I think where we sometimes see issues where you've got multiple investors is if investors have different opinions on what direction the business should be going in, or if one investor is looking for an exit before some of the other investors. None of these are deal breakers, and it's often going to be better to get in that multiple sources of funding, but also I say the various opportunities that can be bought comes down to that trust and keeping an open conversation and dialogue with your investors over time. I think we will wrap up there. So thank you very much to everyone for your time today. Our email addresses were on the slides. We will be circulating the slides to everyone who was on this session, and also a copy of the recording. So if you have any further questions or would like to have a chat about anything kind of investment or M&A related, then please don't hesitate to contact either myself or Mary. And thank you very much for your time.